The dollar is falling, investors are fleeing, and Donald Trump just fired off a demand that could change everything. In a stunning turn of events, China's export restrictions have triggered a ripple effect across global markets, slamming U.S. supply chains and sending the greenback into freefall. Within hours, Trump publicly ordered China to cancel the export cutoff immediately, warning of severe consequences if Beijing doesn't reverse course. But the damage may already be done. Wall Street saw a $1.4 trillion 0 cents dip in market cap. Foreign investors began unloading U.S. assets, and confidence in American monetary strength is slipping fast. This isn't just a trade dispute, it's a full-scale financial confrontation. And the world is now asking, can Washington still set the rules, or is Beijing now in control? Just weeks ago, the U.S. dollar was holding steady, and global markets were cautiously optimistic. Then, everything changed. China announced a sweeping export restriction on critical materials, including rare earth elements, chip-grade graphite, and industrial metals, essential to America's manufacturing, tech, and defense sectors. The official reason? National security. But behind the scenes, analysts say it was a strategic power play, triggered by rising U.S. tariffs, ongoing semiconductor bans, and growing geopolitical pressure from Washington. Almost immediately, ripple effects began. Prices on key raw materials spiked, major U.S. manufacturers issued warnings, and the dollar, long seen as a global safe haven, began to slide. Bond yields wobbled. The stock market reacted. Foreign investors, particularly in Asia and the Gulf, started pulling capital from dollar-denominated assets. Then came Trump's move. The former president, now leading in the 2024 race, publicly ordered China to reverse the restrictions, calling the situation an act of economic warfare. While he has no formal power, yet his influence and the market's volatility amplified the moment. Now, with over $600 billion, 0 cents, in trade hanging in limbo, the world is watching two superpowers collide again. This time, not with bullets or ballots, but with exports, currency, and global trust. On July 3rd, Beijing quietly updated its export control list, adding critical materials like gallium, germanium, graphite, and high-grade lithium compounds. These aren't consumer products. They're the lifeblood of semiconductors, batteries, aerospace systems, and defense manufacturing. At first, it looked like a technical regulatory move. But behind the scenes, it was anything but routine. According to internal memos leaked by South China Morning Post, the restrictions were deliberate and politically timed. China's leadership reportedly saw recent U.S. export bans on AI chips and drone technology as the final straw. The new rules require government approval for outbound shipments of these materials, effectively creating a bottleneck at the source. For the U.S., that's a major problem. Nearly 85% of its gallium and 90% of battery-grade graphite originate from or pass through China. The impact on clean energy, electric vehicles, and military tech was felt almost instantly. What triggered this? Analysts point to a combination of rising sanctions, bipartisan U.S. bills targeting Chinese tech, and Trump's public push for a total trade overhaul. This wasn't a reaction, it was a recalibration. A signal from Beijing that if Washington wants to escalate, China knows exactly where to apply pressure. The U.S. dollar doesn't crash often, but when it moves, the world feels it. In the days following China's export cut, the dollar index dropped nearly 3%, its steepest weekly decline since early 2020. That may not sound dramatic, but in currency markets, it's a landslide. Why the panic? Because the dollar isn't just America's money. It's the backbone of global trade, investment, and energy markets. A sudden loss of confidence can trigger capital flight, currency swaps, and investor exits across entire continents. Foreign investors, particularly from Asia and the Middle East, began pulling back from dollar-denominated bonds, citing instability and over-reliance on U.S. monetary power. At the same time, gold surged past $2,300, 0 cents an ounce, and Bitcoin briefly spiked. Classic signs that money was fleeing to safety. Meanwhile, tech stocks, defense contractors, and clean energy firms, industries dependent on restricted Chinese materials, tumbled. The Dow lost nearly 1,200 points in 3 days. But it's not just about numbers, it's about trust. When the world sees that the U.S. can't guarantee access to critical materials, and that the dollar is reacting violently, they start asking hard questions. And in this case, the answer from the markets was clear. There's turbulence ahead. Just 48 hours after the dollar began to slip and investor sentiment turned shaky, Donald Trump broke his silence with a public, headline-grabbing demand. In a fiery rally speech followed by a late-night post on Truth Social, Trump declared that China's export cuts were an act of economic warfare and ordered Beijing to immediately reverse the restrictions or face massive retaliation. The statement raised eyebrows. After all, Trump currently holds no executive power. But it wasn't about legality. It was about pressure. His words spooked markets, fired up his base, and put the Biden administration in an uncomfortable position. Respond? Or stay silent and risk looking weak? Some called it bold leadership, others called it political theater. But behind the scenes, even Wall Street analysts admitted the timing worked. Markets briefly stabilized after Trump's post, only to tumble again once it became clear that Beijing had no intention of complying. Was this a calculated strike to show strength, or a desperate attempt to regain relevance as economic anxiety grows? One thing is clear: Trump still knows how to move markets. And in an election year, that may be just as powerful as holding office. As the U.S. dollar tumbled and Trump's statements made global headlines, the rest of the world responded swiftly and strategically. European Union officials called an emergency economic coordination meeting, warning that the instability in U.S.-China trade could disrupt global energy, automotive, and defense markets. Germany's foreign minister stated bluntly, "We are witnessing the early stages of a financial fault line." Japan and South Korea, both heavily reliant on Chinese materials for semiconductor and battery production, expressed concern, not over China's restrictions, but over Washington's unpredictable escalation tactics. Behind closed doors, Tokyo reportedly reached out to Beijing to request clarity and continuity in supply flow. Meanwhile, Russia and members of the BRICS alliance took a different tone, openly praising China's move as a sign of multipolar economic resistance. Moscow suggested it would expand joint refining and export projects with Beijing to bypass Western fragility. Even neutral nations like Singapore and the UAE began shifting currency reserves out of U.S. dollars and into gold and yuan-backed assets. This wasn't just a U.S.-China issue anymore. It had become a test of global alignment. A moment where nations quietly chose sides, not in words, but in markets, reserves, and supply routes. With the dollar wobbling and investor confidence rattled, the question now echoing through Wall Street and Washington is simple: can the U.S. stabilize this crisis before it spirals further? The Federal Reserve issued a rare midweek statement, affirming its commitment to currency stability and hinting at possible dollar-strengthening measures. But with inflation still lingering, aggressive rate hikes aren't a politically safe option. Meanwhile, the U.S. Treasury is holding behind-the-scenes discussions with G7 finance ministers to coordinate a response, including possible material stockpile releases and emergency trade incentives. Congressional leaders are split. Some are calling for immediate tariff rollbacks to de-escalate tensions with China. Others want to double down, tightening export bans and expanding sanctions in retaliation for the supply choke. But outside the halls of power, investors remain skeptical. Credit agencies have issued early warnings. Multinationals are pausing U.S. expansion plans. Even major American manufacturers are quietly lobbying for import exemptions, a sign they're not confident the crisis will be resolved quickly. Regaining stability is possible, but it will require swift diplomacy, coordinated market support, and most of all, clarity in leadership. Because in a world watching both Beijing and Washington, the side that looks uncertain loses leverage fastest. This isn't just a trade dispute. It's a full-spectrum test of American economic power. When China cuts off key exports and the dollar responds with panic, the world starts asking, is U.S. dominance still guaranteed? Or is it now subject to foreign supply lines, political volatility, and shifting global alliances? Linda Abbott Tire, when she returned from alias more, Nitsa. Trump's bold response may have been loud, but it also revealed something deeper. Washington is no longer reacting from strength alone, it's reacting from exposure. The dollar may be the world's reserve, but even a reserve needs confidence. And this past week, that confidence cracked. If the U.S. can't secure raw materials, calm the markets, and lead with strategy, not just rhetoric, then it risks more than a currency dip. It risks ceding influence. Because what China proved with one policy update is chillingly simple. Control the resources, and you don't need to fire a shot to move the world. So here's the bigger question, one every investor, ally, and policymaker is now asking. What happens when Beijing doesn't just disrupt the system, but starts replacing it one export, one trade line, one shaken dollar at a time?